I think it's important we consider the difference between actively managed funds and passively managed funds. Actively managed funds versus passively managed mutual funds. What are the difference between them? We will first of all, define what an actively managed mutual fund is. All right. So when it comes to active managements, actively managed mutual funds are managed by professional portfolio managers who make investment decisions with the goal of outperforming a specific market benchmark or index. The overall goal is to be able to beat the index, to beat the relevant benchmark. The fund manager selects individual stocks, bonds, or other assets based on research, market analysis, as well as the fund manager's judgments and experience. So there is this frequent buying and selling. Discover that active managers frequently buy and sell securities to take advantage of market opportunities and adjust to changing market conditions, which often leads to higher trading or transaction cost, transaction fees. So the frequent transaction, buying and selling, do attract a kind of higher level of commission or fees. Number two is a definition of passively managed funds. We've x-rayed what an actively managed fund is. We want to also look at the definition of a passively managed mutual funds. When it comes to passive management, passively managed funds actually, they are often known as index funds. Their aim is to replicate the performance of a specific market index, such as the Standard & Poor, or maybe a bond index. The goal is not to outperform the index, but to match the performance of the index by holding the same securities in the same proportion as the index. That is it. Even the index contains, let's use a simplified index. But an index contains, let's say, 100 stocks. All right. So the passively managed fund will equally buy those 100 stocks and maintain them in their portfolio. So whatever performance is obtainable in the index is also obtainable in the portfolio of the index fund. So they aim at matching the index because it's difficult to beat the market. Actually, it's difficult. So there's a lower trading fee. They don't really trade as much as actively managed funds. So they incur minimal buying and selling fees, and that will result in lower trading costs. Number three is the key differences. What are the key differences between passively managed mutual funds and actively managed mutual funds? So we want to look at management style. When it comes to management style, in active funds, we discover that actively managed funds rely on the skills of the fund managers to make investment decisions with the goal of outperforming the markets. When it comes to passive funds, passively managed funds tracks a specific index, automatically making adjustments to match the index changes without the involvement of the fund manager. So as some stocks are dropped from the index, the fund manager will also drop that stock from their portfolio. So if the index adds a new stock, the fund manager will equally add that same new stock into their portfolio. When it comes to cost, the cost basis now, you discover that active funds tend to have a higher management fee due to research and analysis and frequent trading that is involved. All right. So when it comes to uh, passive funds, the passive funds generally have low fees because they don't require the same level of active management or research. They don't manage actively, they don't conduct any research, they simply mirror. It's a very simple, straightforward strategy. They buy what is in the index and they sell whatever the index, what is no longer in the index. All right. And so when it comes to performance, active funds, in this case, there is a potential for higher returns, but also higher risk. Active managers can potentially outperform the market, but there is also the risk they might underperform. Of course, they underperform a lot because a vast majority of active fund managers don't outperform the index. They don't beat their relevant index. That's just the facts of the matter. So as for passive funds, while passive funds typically don't outperform the markets, they aim to match the performance of the index, often providing steady returns that that mirror the markets. They tend to mirror the market. They don't really trade actively. If the market makes returns, they make a similar or same level of returns. Let's consider the risks this time around. When it comes to the risk, actually, active funds, in this case, active funds carry the risk that the fund manager decisions may not lead to positive returns and they may underperform the benchmark. That's quite prevalent, actually. They most of the times underperform their benchmark. And in addition, there is these passive funds. Of course, passive funds carry less risk. They carry a lesser level of risk of underperformance since they are designed to mirror the performance of the index, though they still experience market risk. Anyway, if there's a prevalence of market risk, you discover that passive funds will equally partake or be affected or be impacted by that risk. Please don't forget to subscribe to this channel and like this video if you've not done that. Number 4 is benefits of actively managed funds. Let's look at the advantages in these regards. There's this potential for outperformance. So while in skill managers, active funds may offer the possibility of higher returns, especially in a volatile or inefficient markets. There is cases of outperformance here and there. They're not all that prevalent, but it occurs from time to time. And there's flexibility also. So active managers can adapt the portfolio in response to changing market conditions, economic factors, or company-specific news. Number 5 is the benefit of passively managed funds. We've just discussed the benefit of actively managed funds, which include, outperformance and flexibility. We want to look at the benefit of passively managed funds. So in this case, it's lower cost, there's consistency, and there's diversification. When it comes to lower cost, passive funds are more cost effective due to their lower fees and minimal trading activities. So they are like cost efficient. The cost implication is quite minimal, and there's consistency. Passive funds provide that consistent returns, that tracks the markets, making them a good option for long-term buy and hold investors. And then lastly, there's diversification. Passively managed funds, especially index funds, often provide instant diversification by investing in a broad range of securities within the index. So in conclusion, the main difference between actively managed and passively managed mutual funds lies in the management style. the cost as well as performance performance expectation. So from this video now, you could determine whether you want to invest actively or whether you want to, invest passively. I think the choice is yours to make. I'm not a licensed investment advisor, so I can't tell you what to do or what not to do. It all depends on your peculiar circumstance, your investment objective, as well as your time horizon.